If I gave you 3 guesses about how much you'll earn in your entire career, I bet you wouldn't guess your actual number. Most people drastically underestimate their earning potential, especially early on. But underestimating also happens to the best investors in the world. Warren Buffett has said he routinely underestimates the power of compounding returns. And the earlier you start investing, the more profound that effect becomes. It took me a while to grasp this concept, but it's been revolutionary to my mindset around money. There are a lot of topics in investing. So to surface what really matters and gives you the most leverage early on, here are 10 rules of smart investing. Rule no uno: accept losses as part of the process. Loss is inevitable. Even the best investors lose money sometimes. So don't be surprised when it happens, and don't panic when it does. A common trap is to think of investing as a zero-sum game where you must beat someone else to win. But investing isn't a battle. It's a marathon against your own impulses and biases. Beating the market doesn't mean being smarter than everyone else. It means doing simple things consistently. Accept that losses will happen. Prepare for them mentally and financially. Then keep doing the right thing. Rule non dos: don't fall in love with your investments. You don't need to hold on to something just because you already own it. You want to hold on to it because you believe in it. Don't become emotionally attached to a stock, crypto, or NFT project. Instead, ask yourself what you're betting on and whether that thesis is playing out. If not, sell and move on. A related trap is falling in love with complexity. Simple trades often do better than complex ones. But complex trades feel sophisticated. There's nothing wrong with investing in stuff you understand. So don't try to impress yourself or others with fancy trades. Rule no tres: do the hard work up front. Due diligence takes time, but it pays off. Don't skip research to chase fast gains. Do the work up front to position yourself for success. The more effort you put into understanding your investments, the better equipped you'll be to weather short-term volatility. A related trap is not knowing when to stop digging. Every investment will have more information, data, and arguments you could look into. At some point you have to stop. Trust your analyses and pull the trigger. Stop digging once you've exhausted all reasonable sources and perspectives. Rule non cuatro b: independent. Independent thinking is essential. Don't blindly follow the crowd or influencers. Trust your own analysis and make your own decisions. Follow people whose track record you admire, but adapt their ideas to your own situation. A common trap is relying solely on experts or gurus. Yes, they might have a great track record, but they're not mind readers. You know your goals, risk tolerance, and constraints better than anyone else, so don't abdicate your decision-making responsibilities. Rule no. 5. Diversify. Diversification reduces risk without sacrificing potential returns. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, industries, and geographies. Diversification protects you from unexpected events and allows you to ride out market fluctuations. A related trap is diversifying too much. Spreading your portfolio too thin can dilute returns and increase transaction costs without providing much additional benefit. Find the right balance between concentration and diversification. For most people, that sweet spot is around 15 to 25 investments. Rule no a seis: think long-term. Long-term thinking trumps short-term gains. Don't gamble with your investments or make impulsive decisions based on market noise. Think about your investment horizon and goals and stick to your plan. A common trap is confusing the long-term with forever. Don't be afraid to change your strategy or asset allocation over time. Your needs and goals evolve, so your investment plan should too. Rule no ansiety: control your emotions. Your emotions can be your worst enemy when it comes to investing. Don't let fear or greed drive your decisions. Stay rational and stick to your plan. A common trap is hoping to retire early. While it's possible, it requires extreme discipline. If you want to retire early, be prepared to make significant sacrifices and stick to a very strict budget. Rule no an ocho: don't chase returns. High returns often come with high risks. Don't sacrifice your long-term goals for short-term gains. Invest in assets that align with your risk tolerance and investment horizon. A related trap is confusing risk with volatility. Volatility is the ups and downs of the market, while risk is the potential for permanent loss. Just because an investment is volatile doesn't mean it's risky. And just because an investment is not volatile doesn't mean it's not risky. Rule no a nueve: have a margin of safety. Margin of safety is key. Don't invest in something unless you have a margin of safety, which is the difference between the price you pay and the intrinsic value of the investment. This provides a buffer for unexpected events and helps you sleep at night. A common trap is valuing businesses based on future projections. While projections can be useful, don't rely on them. Instead, focus on a company's current financials and growth prospects. Rule number 10. Keep it simply. Simplicity is golden. Don't overcomplicate your investment strategy. Stick to a simple plan that you can easily understand and maintain. Complexity often leads to mistakes and suboptimal decisions. A related trap is trading too much. The more you trade, the higher your transaction costs, and the greater the chance of making a mistake. Be patient and wait for the right opportunities. If you haven't invested yet, start small. Even if you can only invest $5 a month, that's still $60 a year and $720 over 12 years. With compounding, that can turn into thousands. If you haven't invested yet, start with what you have. Whatever that is, the future will always seem bleak. The more money you make, the more you'll need to save to retire. But you don't need to be rich to start investing.